I'm beginning to see where you guys go. Yeah, we're gonna have to have another fraud, I'm afraid it's gonna be big.
As far as I'm concerned, it's so big out there. I don't think they really compete.
I agree with you.
No.
Honey, could you just move to your right or left?
Yeah.
Okay, good.
Yeah, I'm just doing this here.
You're okay.
Let's see.
Thank you, ma'am.
All right. So now let's continue to pick up where we left off. Different types of firms. We have manufacturing, merchandising, and the service sector. Now each one of these are going to be using cost, but they use cost accounting in different ways. So the manufacturing, when you're using cost accounting and you're thinking of cost accounting and the type of business, most of the time you're going to be thinking of manufacturing, okay? And a lot of the homework assignments throughout this semester is going to be dealing with manufacturing. So it's the sector companies purchase materials and components and convert them to finished products. So it would be BMW, it would be Boeing, it would be, Nestle up here.
Yeah.
You know, things like that. They are manufacturing companies, and they are going to do a lot of cost accounting. If you're going to be a cost accounting, you're probably going to go work for those type of companies. They are the biggest need for those. Then we have the merchandising sector, which are companies purchase and then sell tangible products without changing their basic form. Clothing, so it would be not the manufacturer of the clothing.
No.
It would be the American Express or the Express in the mall. It would be J.C. Penney's. It would be Walmart. You know, so it would be your retail establishments.
Okay.
Okay? And then your service sector companies provide services like legal advice or audits. So it would be the garage door company, it would be the electric company, you know, the law firms, the accounting firms, okay? They could use cost accounting too, okay?
Well, anybody can.
Anybody can, yes. And so, but, you know, so if we're talking about a manufacturing, of course, that would be cost for the different products. If we're talking about the retail, what would that be? What would we concentrate on? Could be different departments. Like if you're looking at the Walmart, could be the dairy department, it could be the bakery, the clothing. Yeah. Okay. Now in a service sector company, what could it be? It would be like a particular job of an audit, you know, cost object type thing. It could be a tax return. A law firm would be a lawsuit, if, you know, a particular case that's going on, and what are the costs associated with that.
Wow.
Okay, so you can really get into details. So, okay, now when we're talking to manufacturing, that's really what we're going to be focusing on in this class is manufacturing companies. We have different things that we have to deal with. In the inventory, you basically have 3 types of inventory. You have the raw materials or direct materials. You have work in process and finished goods. Now, I always like to, I like to do pictures. You know, I like to think of, you know, physical look and see how things go. And so I think of rooms when I look at this.
What?
Rooms, you know, rooms, yes.
Yeah, okay.
All right, so I have one room over here that gets all the raw materials. Okay? I know that doesn't spell right, but it's okay. Okay, so that would be, you know, the different parts. So if I'm a clothing manufacturer, it'd be all the bolts of material. It would be like the thread and things like that. If it's a car manufacturer, it'd be all the parts together. It'd just be a room of parts, okay? And then from that room, if I was the manager of the production floor, I would request the materials out of the raw material room and bring them next door to the work in process room.
Right.
Okay? And then,
Out there on the dock, you know, it's good.
yeah. So I would finish it when they finished producing the product. So, this table, say I had lots of different pieces of wood for the table, and then I requested it from the raw materials. They went into the production room, and we built the table, and now it goes into the other room, the last room here, and that's my finished goods. And then from there, it will go to cost of goods sold. It'll go out the door to the customer. Okay? So I always look at different rooms. Okay, this is the room where it's just raw material. Nothing's done with it. And then I have the next room over is what I've done with it. I've started working on it. I'm producing the product. And then the last room is going to be my finished product. Everything that's done goes in this last room. And then it goes out the door. Now, in merchandising, companies hold only one type of inventory, merchandise inventory. Okay? So on a manufacturer's books, you're going to have 3 different types of inventory. You're going to have the direct materials or raw materials, you're going to have work in process, and you're going to have finished goods. That's all on a manufacturing books. So on their balance sheet. And then if you're merchandising, so if you're Walmart, you only have one inventory account, and that's the merchandising inventory.
For all the products.
Do they break that down into different kinds of inventory underneath merchandise inventory?
It could be broken out by department, possibly.
Yeah, that's what.
Yeah.
You get all your jewelry separate from your.
But still, it's still different types of inventory.
Yeah, it could be,
Because you have electronics, which is
it probably more likely broken down by store. And, like store 1, store 2, store 3.
Well, why wouldn't you think each store breaks it down into different
It
departments?
could, it depends on how detailed they get. Walmart probably does, just because they have the capabilities to do that.
A big merchandise store like that or JCPenney's, how would you think they break it down into
Different departments.
Yeah.
But if you're talking a little mom and pop store,
No.
but like a big JCPenney's or Sears or Walmart or something, they probably have the technology to be able to break it down by store, by department.
So they probably have the accountants, breaking it down themselves.
Yeah. Mm-hmm. So, but if you're
Whoever does the ledgers books.
so the more bigger the store, probably more detail they get. So, all right, commonly used classifications for manufacturing costs, also known as inventoriable costs. And so you're going to be concentrating on 3 buckets. When we're talking about manufacturing costs, we're going to be talking about 3 different buckets. The first the first 2 buckets are really the easiest buckets to determine. And that's your direct costs for labor and your direct costs for materials. Okay? So materials, acquisition cost of all materials that will become part of the cost object. So it would be the wood or for the car, it would be the steering wheel, the tires, the steel, the seats, things like that. The direct labor, the compensation for all manufacturing labor that can be traced to the cost object. So all labor associated with that's considered direct labor. And then we have the indirect manufacturing costs, which are the factory costs that are not traceable to the product in an economically feasible way. Examples include lubricants, indirect manufacturing labor, utilities, and supplies. Okay? So those are the little things that, lubricant, you can't say I used 1 ounce of lubricant on this one car. And because that is not cost effective to get down to that. So that is considered an overhead. Utilities, of course, that's overhead because I can't say this kilowatt of energy I can tie to this car. Not cost effective.
Stuff,
Yeah. Okay. So 3 buckets, we're going to be using 3 buckets in pretty much all that we do. Direct costs for labor, direct materials, and indirect manufacturing costs. Now, inventoriable costs are inventoriable costs are all costs of a product that are considered assets in the company's balance sheet when the costs are incurred and are expensed as cost of goods sold only when the product is sold. For manufacturing companies, all manufacturing costs are inventoriable costs. Okay? And then we have period costs. Period costs are all costs in the income statement other than cost of goods sold. They are treated as expenses of the accounting period in which they are incurred. Okay? So pretty much, direct material, direct labor, those are going to be inventoriable costs. But anything else, think of the indirect is going to be period costs. Because they're just costs that we take care of when we get them. Okay? Questions? Cost of goods manufacturing and cost of goods sold section of the income statement are accounting representations of the actual flow of costs through a production system. Note how inventoriable costs through the balance sheet accounts for work in process and finished goods inventory before entering the cost of goods sold in the income statement. All right, so basically the cost of the inventoriable cost, which is the direct labor, direct materials, they are going to be on the balance sheet, and they are going to stay on the balance sheet until we sell it. Okay, and it's a flow. You'll see the flow here in a few minutes on how we go. So, inventoriable costs are the direct material cost, $73,000, direct manufacturing labor and manufacturing overhead costs, $20,000. So, what happens is we have beginning inventory and direct materials of $11,000. We purchased $73,000, okay? And then we have an ending of $8,000. Well, that means, guess what? That means $76,000 went out. And how did I get that? I have 11 plus the 73 I bought. So I have a total of 84,000 that is available for manufacturing, right? Now at the end of the quarter, I only had 8,000 left. So what does that tell me? $76,000 worth of inventory left the raw materials room, the direct materials room. Okay? So you take the beginning plus your bought, and then subtract your ending, and that's how you get your money that moved from materials used, or from direct materials inventory to work in process inventory. You do the journal entries. So we're going to do the journal entries for that too. So basically what will happen here on your balance sheet, anytime you purchase stuff, money or materials, they will go into raw materials or direct materials account. So what will happen is, say if I have a T account for direct materials, and that's an asset on the books, right?
Yeah.
And if I have an asset, what's the normal balance of an asset account? A debit or a credit?
Yeah.
Debit, okay? So I have 11,000, right? And so then I purchased 73. So that increased direct materials by 73,000, right? So when I purchased those, I said direct materials, a debit, of 73,000
Yeah.
and say accounts payable for
Okay.
73,000. That's your entry when you purchase all that, right?
Okay.
Now, what happens here, we have work in process.
Okay.
Now, what happens here, I know that I end up with
6,000.
8,000. 8,000. So that means I have to move 76,000 out.
Yes.
Well, if I do a credit to direct materials, where's it going? It's going to the next room, which means I have to debit
Yeah.
work in process, 76,000.
Okay.
So I'm going to say work in process for 76,000, and I'm going to correct or credit direct materials for 76,000. Okay? So now on my balance sheet, what happened? I have two accounts so far. I have the direct materials. At the end of the quarter, I'm going to have $8,000 as on my balance sheet. And then I'm going to have a second inventory as work in process. And we're going to be adding a little bit more to that here in a few seconds, okay? All right, so then the direct manufacturing here, what happens here? They go to work in process. So normally, in a normal setting, what would you do when you paid someone? What do you debit when you pay someone? Huh? Yeah, your wages expense, right?
Right.
But in manufacturing, if it's direct labor, what we're going to do is work in process. I know that's not right. Okay, and how much was it? It was 9,000. And say we paid cash, because we usually pay cash for labor, right? And so now in my work in process, I have that $76,000 in direct labor or direct materials, and $9,000 in labor.
Starting at the account, beginning inventory, 6,000.
Yeah. Thank you for catching that. Sorry about that. We had a work in process already in there, 6,000.
Okay.
Okay. Now, my manufacturing overhead costs. So those could be any numerous costs, right? And so again, what would you do? Debit the manufacturing overhead, or you would work in process. Actually, there's a whole process. We'll be doing this here in a few minutes, or I think next week. And work in process be 20,000. And so we would debit work in process again for 20,000. Okay? The other side of that we'll be talking about later, so don't worry about that journal entry yet. Now, so I have the original 6,000 in work in process. I added 76,000 in direct materials. I added 9,000 in direct labor, and I added 20,000 in direct or manufacturing overhead costs. My ending inventory was 7,000, so that tells me if I add all those numbers together and subtract the 7,000, I have to move out of work in process 104,000. And so 104,000 would go from work in process, which would be a credit of 104,000, and I would now have a third inventory account on my books, finished goods, 104,000. Okay? Now, we have the T account here for finished goods. We started off with 22,000, and we're adding the 104, right? So we started off in finished goods with 122,000. We added 104,000 from work in process. They finished it off. Now they're telling me my ending inventory is 1,800 or 18,000. I'm sorry. So if I add the 22 and the 104 and subtract the 18, what do I get? 108. Thank you. My brain's not working. All right. So then what do I have to do? The journal entry is cost of goods sold as a debit of 108. And I move them out of finished goods at 108. So that kind of gives you a journal entry representation of what goes on with the inventory of a manufacturing company. Okay? So every step of the way.
This is explained so much easier than major had.
Yeah. Yeah.
We should have had this in a journal, Kenny. That's what basically what it is.
Yeah.
And it explains it so much easier.
Yeah.
Good.
What's the number on the last work in progress on the left?
20,000.
How much?
20,000. Okay? So basically, what we have here is different steps here. So all of this from here, from the finished goods all the way to the left, all that's on the balance sheet. Everything else, the revenues, the cost of goods sold, that's going to be on the income statement. And then we have equals the gross margin. So if you take the revenues of 210 and then the cost of goods sold, which is 108, we have a gross margin of 102. And then after that, we have period costs. Period costs in this case are going to be my R&D costs, my research and development costs, my design costs, my marketing, my distribution, my customer service, things that I cannot tie to the direct manufacturing of the product itself. Okay, it has nothing to do with manufacturing. It has everything to do with either before the manufacturing process starts or after it's completed, our period costs. And that equals a total of 70,000. So my operating income here is $32,000. Good.
I was so lost in managerial accounting, I couldn't tell you what was what.
Yeah, you held on to the end, right?
Yeah, I barely passed it.
Yeah, right.
But I mean, I gotta see it, and so I understand this a lot better than what I did when I.
They also said the second time around, it makes it easier for you.
Well, I still couldn't tell you what was what.
Yeah. All right, so a multi-step income statement. What is a multi-step income statement? We have it's basically broken up in two parts. The cost of the actual product produced, and then everything else. So you determine your gross margin, which is revenues minus cost of goods sold. Now, in this case, they go into detail. They start off to get the cost of goods sold. They show you the 22,000 of beginning finished goods. So finished goods inventory is only going to be on here, okay? Finished goods are 22. The cost of goods manufacturing, which is our 104, okay? So it's the 22 that we started off. The 104 that came from work in process, that totaled 126. And then we backed out what was left over after everything was sold for that particular period of time. And I only had $18,000 in inventory. So I take the 126 minus 18, my cost of goods sold is 108. And then we take the 210, which was the revenues, minus the 108 gives me my gross margin of 102. And then we list all the operating costs after that, which include the R&D and such. So 70,000, and then we come up with the operating income of 32.
So this is just an income statement for
A manufacturing company.
manufacturing for.
Mhm.
So if you use the cost account, and so what's this?
Yeah.
So I mean, this income statement doesn't go into detail with. Is it in detail with everything like you know what you buy, your assets, and all that stuff still?
Well, that goes, are you talking about the balance sheet, or are you talking about the statement of cash flow?
Everyone.
Okay. Okay, all right. All right, so that's the first part of the income statement, was the top part. Now, in the multi-step, we have the second part, which is the cost of goods manufactured. And this is where you're going to find the direct materials, the direct labor, and the overhead costs. This is how I got to my cost of goods. So, the detail behind all those numbers we had earlier, So we have the direct materials. We have that section, which is this T account that we talked about, where we started with 11, we added 73, we end with 8,000. So my direct materials used is 76,000. My labor, that's pretty straightforward. You're not going to have really a lot to figure that out. They're going to, that's what you pay direct labor. Okay. So in this case, it was 9,000, and then my overhead. And so in this case, they tell us we have indirect manufacturing of 7, or labor of 7, supplies of 2, our utilities are 5, depreciation 2 and 3, so 5. Then we have miscellaneous overhead, which was 1,000. Total manufacturing overhead was 20. My manufacturing, if I add these up, I get 105. Okay. And then that's where, what? Did we do a journal entry for 105? No, we did not. We have beginning work in process of 6,000. And so the total manufacturing cost to account for is a 111. We back out the 700, and that's how we come up with a 104 that we backed out. Okay? So that's the second part of it. Okay? Oh, yeah.
76 to 9.
Yeah, okay, yeah. Okay. So you're going to see all this on the income statement, but it's in 2 sections. You have section A, which is pretty well an overview, and section B is going to be breaking down the costs.
This is going to be two different, like 2 sections.
Uh-huh. Okay. Now, other cost considerations include prime costs, conversion costs, and overhead labor costs. Prime cost is a term referring to all direct manufacturing costs. So when you have a question that's asking you what are the prime costs, anything that are directly related to the product is prime cost. So prime cost would be all your direct materials and all your direct labor. So then we have conversion costs. Conversion is a term referring to the direct labor and indirect manufacturing costs. So think of it like this. If we have the direct materials and the direct labor and the overhead. These top 2 are period costs. And then the middle and the last one is conversion cost. And you're like, okay, why do we care about that? Okay? Because when we look into a work in process, think of it this way. If I'm taking everything from all the materials used, I'm going to use up all that materials right away, right? When I put it into the work in process. But as the product is being produced, evolving, more labor is involved and more overhead is involved.
Sure.
So I'm adding to the cost. I'm kind of starting with the direct materials,
Yeah,
and I'm adding on to it. Okay? So think of it that way. Now, overtime labor costs are considered cost part of indirect overhead costs. Why is that? Why do you think I don't just say that's a direct cost because he worked overtime? Yes, but he worked on this particular item. You're not nuts. It could be because he could pick and choose what he works in the overhead time, right?
But what about those companies that don't hire people so everybody gets overtime?
Yeah, but the overtime, again, it doesn't, you can't really tie it to a direct vehicle. Because if I didn't have if I didn't have overtime, say it would just be, that vehicle just wouldn't be touched until the next day when regular time starts again. Okay? I can't really tie overhead time to a particular item. Because it could be this item if I choose this item, it could be that item if I choose that one. And why? Huh?
It can even be a meeting.
Yeah, exactly. So I can't really tie it directly to a particular item because of the fact that, I can choose what I work on. And why should this item cost me more because I worked on it, after I got 40 hours than this item, and they're the same item. Okay? So that's pretty much why. All right, measuring cost requires judgment because there are alternative ways for management to define and classify costs. Judgment is required. Managers, accountants, suppliers, and others should agree on the classifications and meanings of the cost terms introduced in this chapter and throughout the book. So, one person might decide to say the best way to allocate costs is based on machine hours. And then someone else might say, no, it's based on labor hours. All right? So it's really a judgment call. I, as an accountant, might go in there and say, oh, this is machine hours. Easy. I got to base everything on machine hours. But then the next person who comes in after me might have a totally different concept of the manufacturing system and say, no, labor hours is really what drives the cost. So it's really judgment, and that's when you have to have everybody in agreement on how things are done and how they are classified. Now, different product costs for different purposes. Pricing and product mix decisions. Decisions about pricing and maximizing profits is one of the reasons why we do cost accounting. Contracting with government agency, very specific definitions of allowable costs with cost plus benefit of profit contracts. Preparing external use financial statements, gap-driven product cost only. So basically, these are different product costs for different purposes. So what you might decide is a product cost for, say, pricing and product mix decisions. So if I go into this and say, okay, should I produce this item or that item? Or what kind of different combination of the two do I use? So I'm going to look at different costs than I do, say, if I'm working for the government, they actually tell me what those cost. So I might say, okay, this cost me this, but if I look at it based on the requirements of the government, it could cost me something different, right? And then, of course, then you have a third way of doing things is how does it on the books? So what I might think is a product cost when I'm looking at a product and whether I should produce it or not, if I follow GAAP, it would not be a product cost. It would be a cost that's a operational cost. It would be after the fact. Okay? So I might include it in product cost, but GAAP says no. It should be an operational cost. Does everybody understand?
You got to bow your chin.
I'm sorry?
No question, you got to bow the gap.
All right. So different products cost for different purposes. So this is the order that we do manufacturing, right? We have research and development costs. Now, when I'm doing product costs for myself, is that going to be actual on the product costs? If I'm doing direct material, direct labor, and overhead, is R&D on it, or is it operational cost? It's an operational cost. It's not directly for the product itself. It's developing the product, right? And so that would be operational cost. Design costs, and then production costs. Now, production cost is only on the financial statements. So all the other costs are going to be operational costs on our books based on GAAP. But production cost is the only thing that's going to be part of production costs. Now, for products, costs for reimbursement under government contracts, they say we go from research and development, design, and product costs. Everything after that is not part of your cost for the product itself. Okay? Whereas if I'm a manager, I'm going to look at everything. Okay? So that kind of gives you a little idea of what a picturesque way of looking things. And this is actually on page 48 in your book. Okay? So production costs would be the only thing that's in product costs on the financial statements. If I'm working for the government, they might reimburse me for some of my R&D, my design costs, and my production costs. That as a person who is looking to determine if I'm going to make this product, I'm going to look at all the costs involved.
That's good.
Yeah. All right. Framework for cost accounting and cost management. The following three features of cost accounting and cost management can be used for a wide range of applications. Calculating the cost of products, services, and other cost objects, obtaining information for planning and control of performance evaluation, and analyzing the relevant information for decision making. So pretty much that's the overall picture of what everybody does. As a cost manager or a cost accountant, you're going to be doing these three steps. So you're going to calculate the cost, obtain information, and analyze the information. All right, any questions? Now, the other things that are left are basically the terms to learn. And what I would advise you to do is take each one of these terms, write them out, write out the definitions. Again, just like in chapter 1, to make sure you understand these words. Now, these are the words that are going to be used a lot the rest of the semester. So there's very important that you understand actual costs, budgeted costs, conversion costs, and so forth. These are key words that you're going to need for the rest of the semester.
Just those,
All of them. Yeah, all of them, all the way from actual cost down to cost tracing. And then the next page,
Did we go over conversion cost again?
conversion costs.
Yeah, or you want to say that for later?
No. Again, conversion costs go up here. Basically, remember, if you look at the three types of costs, the direct materials, direct labor, and overhead,
Yeah.
the top two are prime costs. You're always going to have, those are the primary costs involved. The most cost involved,
Yes.
okay, is the direct materials and the direct labor. The conversion costs are going to be direct labor and overhead. Okay? Because you're taking, basically, what are you using to convert the direct materials into the product?
Most labor and.
Yeah. What do you use to convert the materials into the product that you want? Direct labor and conversion costs, or indirect overhead costs. Okay?
But if you, okay. All right.
Okay? So top two prime, bottom two conversion. And I can pretty well let you know that there's going to be questions about that on the test. The wording is going to say what are the prime costs, what are the conversion costs. I'm sorry? Period costs. Period costs.
You're saying prime costs.
Yeah, period costs. I'm sorry. Period costs. What are the period costs? What are the conversion costs? You're going to have questions about that. Okay? 2 weeks? 3 weeks? 3 weeks. 2 weeks. I think so.
Will we take our testing here or
As of right now, I'm being here during class, and it's during week 6. So that's February 15th. Okay? Yeah,
So is it gonna be a blackboard, or is it gonna be here? We need to bring our laptops.
it will be a written test. If it's in here, then it's going to have to be a written test.
your dates on there all the week?
Yeah.
Okay, yeah. So it's week 6, so that would actually be the 22nd. It's 3 days.
Got it.
So these terms on May 15th, which will be